Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. We are witnessing one of the most significant sector rotations in recent memory. The AI earnings reset is here, and Q1 2026 is forcing a brutal reassessment of tech valuations. What looked unstoppable in 2024 and 2025 is now facing a harsh reality check as margin compression meets investor impatience. The performance reversals tell the story. According to Investors Business Daily, advanced micro devices gained 77% in 2025. That momentum has completely stalled. AMD is down approximately 6% year-to-date in 2026. Snowflake, the cloud data platform, posted a 42% gain last year, but has cratered 23% so far this year. Broadcom rallied 49% in 2025, now down 7% as investors reassess AI infrastructure valuations. These are not minor corrections. These are fundamental repricing events driven by one central concern: margin compression from aggressive capital expenditures. Goldman Sachs' portfolio strategy team captured it perfectly. The issue is not earnings today, but uncertainty around margins tomorrow. That statement is driving billions in capital allocation decisions right now. Here is the paradox. Global AI spending is projected to hit approximately $2.5 trillion in 2026, representing a 44% year-over-year increase. Massive capital deployment, transformative technology. Long-term potential is undeniable. But that aggressive spending pace is creating immediate pressure on quarterly earnings and cash flows that investors are refusing to tolerate at current multiples. Tech giants like Amazon are pouring capital into AI infrastructure build-out, data centers, semiconductor development, cloud capacity expansion, advanced algorithm development. These are necessary investments for long-term competitiveness, but they are crushing near-term profitability metrics. Investors who bought the growth narrative during the euphoria period are now facing uncomfortable valuation questions. So where is capital rotating? Into fundamentals, into income, into defensives. According to Morningstar's Markets Brief report on the big 2026 sector rotation, energy stocks have emerged as significant beneficiaries. Oil prices are up approximately 12% this year, and energy equities are capturing those flows. Investors are also rotating into consumer staples with defensive characteristics, industrial companies with steady cash flows, and traditional sectors displaying robust fundamentals. This is a move away from speculative, capital expenditure-driven narratives toward assets with established profitability and defensible market positions. The market is demanding companies that demonstrate consistent case generation, manageable capital requirements, clear paths to margin expansion, and proven business models with sustainable competitive advantages. The bond market is experiencing massive inflows as investors seek stability. The Breckenridge Capital Advisors Q1 2026 corporate bond market outlook reveals compelling trends. In 2025, the Bloomberg U.S. Investment Grade Corporate Bond Index generated a total return of 7.77%. Yield to worst reached approximately 4.81% as of December 31st, 2025. Quality spreads remain tight, indicating strong credit conditions. Looking at 2026, Treasury yields are expected to trade between 4.0 and 4.5%. Investment-grade corporate bonds maintain attractive income propositions in this environment. Potential new issuance could exceed $2 trillion, providing ample investment opportunities for institutional allocators. Taxable bond funds attracted nearly $500 billion in inflows during 2025. That trend is accelerating in 2026 as tech sector margin concerns intensify. The expectation of one additional rate cut in 2026, combined with a softer labor market, is reinforcing defensive positioning in fixed income markets. Institutional capital is migrating aggressively into credit. The valuation reassessment in tech is forcing investors to redefine what constitutes reasonable pricing in an AI-driven economy. Previously perfectly priced stocks are being repriced as investors demand more immediate evidence of profitability. High multiple growth stocks are getting compressed, while value-oriented positions with cash flow generation are regaining favor. Several macro forces are amplifying this rotation. The Federal Reserve's cautious approach to rate cuts is maintaining higher discount rates for future cash flows, which punishes long-duration growth assets. Persistent inflationary pressures are forcing investors to prioritize current income over future growth promises. Geopolitical uncertainty is reinforcing the flight to quality and defensive positioning across asset classes. Professional investors are adapting strategies in real time, reducing exposure to high multiple growth stocks, increasing allocations to value-oriented positions, diversifying across sectors and asset classes, emphasizing cash flow generation over revenue growth. Quality metrics are becoming more important than growth narratives. Income-generating assets are experiencing renewed institutional demand. The AI infrastructure build-out encompasses data center expansion and modernization, semiconductor and chip development, cloud computing capacity increases, and advanced software development. While these investments are necessary, they create immediate pressure on quarterly earnings. The market is no longer willing to wait indefinitely for returns on these capital outlays. This recalibration is healthy for long-term market stability, but painful for investors who position heavily in AI themes during the euphoria period. The current environment represents both a challenge and an opportunity. AI-focused investments face near-term headwinds, but underlying technology trends remain intact. Investors who can navigate this transition period while maintaining exposure to long-term themes may be well-positioned for future outperformance once margin visibility improves. Critical observations for positioning. Margin compression concerns are driving significant sector rotation. Traditional sectors with strong fundamentals are regaining favor. Fixed income markets are attracting substantial institutional capital. Spending continues to grow, but at the cost of near-term profitability. Defensive sectors are outperforming growth-oriented investments right now. The Q1 2026 earnings season has catalyzed a significant shift in market dynamics. The AI revolution continues, but investors are demanding more realistic timelines for profitability and sustainable business models. Previously overlooked sectors with stable earnings and cash generation are capturing capital that fled AI stocks. Energy, consumer staples, industrials, and investment-grade credit are benefiting from this reassessment. For traders watching price action, the key levels to monitor are sector rotation flows, credit spread movements, and yield curve positioning. If investment-grade corporate spreads remain tight while Treasury yields hold the 4 to 4.5% range, fixed income offers compelling risk-adjusted returns relative to compressed tech multiples. If energy continues outperforming on sustained oil price strength above current levels, that rotation has further room to run. The AMD, Snowflake, and Broadcom reversals are not isolated events. They represent a broader reassessment of what AI infrastructure investments are worth when margin visibility deteriorates. Until companies demonstrate they can deploy capital at high returns without sustained profitability compression, multiples will remain under pressure. Goldman Sachs was right. The issue is not today's earnings. It is tomorrow's margin uncertainty. That uncertainty is driving one of the most significant sector rotations in recent memory, reshaping how investors think about growth, profitability, and sustainable returns in an AI-driven economy. Position accordingly. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.